Um, okay. Hi, everybody. I hope you can all hear and see me correctly.
Yes, we can.
I'm just okay, super. Given overwhelming responsibilities and tasks on my plate work-wise, I haven't put together a specific presentation, but I'm going to pull up one that I've used for the Beyond Investing business, which is obviously in the money markets, and we'll lean on a few of those slides as I'm talking through about the financial system and the game of money for um, for what it's worth. So I'll just pop that up. Okay. And I need to go to full screen. Okay. All right. Yes. So as I mentioned, this is originally a bond investing presentation, but I will just adapt what I say to make it less promotional and more educational. Um, so just going forward, just one second, just moving us forward. Okay. So I mean, as many of you know, I've been active since 2017 when I left my kind of proper job in the financial markets, creating a group of companies which are delivering portfolios, so aiming to invest in a vegan fashion, by excluding as far as possible and practicable exposure to all forms of exploitation of and cruelty to animals for food, clothing, or any other purpose. And there are many other purposes. We have been creating portfolios which promote the development and use of animal-free alternatives and promoting direct investments by marketing other deals for companies in our portfolio and other companies to other investors. And the overall idea is to accelerate this transition to an economy free of animal exploitation. And I just really want to stress the fact that basically the vast majority of harm to animals is as a result of a commercial exercise, and is because a large part of our economy is actually embeds that exploitation into their business models. And if we get onto those slides, you'll see that approximately, over 30% of, we exclude about 50% of companies for various reasons, including some environmental screens, but over 30% of the companies, over 30% of the stock market, we are excluding for reasons of animal exploitation. So this is a huge part of the global economy. And it relies on funding, and it relies on various different types of funding, and I'll go into that as we go further on. So our vision, a kinder, cleaner, healthier world, and obviously the kindness extends to humans, but particularly to animals. That's me. I've had a lot of experience in finance, investment, in banks and investment houses. The vegan part of my financial career was really since about 2016 when I started investing personally. But prior to that, I was really in the kind of capitalism read in tooth and claw end of the market. Allborn Partners that I worked for from 2004 onwards was advising investors on investments in alternative assets and particularly hedge funds. And if any of you have heard the word hedge funds or heard anything about them, then you probably think that they are the worst end of the financial market. And in some ways they are, frankly, because they are completely devoid of any kind of principles, let's say, in terms of whether they should or should not invest in certain assets. One of the reasons that I came out of it was because of some of the conversations that I was having. Particularly, there was one conversation with a hedge fund manager that had made money by bringing a coal business, which did subsequently fail, but he brought that coal business out of bankruptcy and enabled it to continue functioning for several years, thus, making money out of harming the workers because their safety records were very poor, and also obviously creating more carbon emissions. I would also say that a number of people in that industry are also funding such things as Heritage Foundation and other types of entities, which particularly on the very right-wing end of the spectrum, which are hampering progress towards climate goals as well. So it's very important to note that a lot of people do make a lot of money in the financial industry, and when they've made money in the financial industry, they are not necessarily putting that money to beneficial use. There are some that do, and I could also list some examples in that direction as well. But there are some which are using that money in a very negative fashion towards the environment, towards animals, towards other human beings as well. So that was the Auburn Partners part of my career. Prior to that, I was at UBS in equity derivatives and convertibles marketing and structuring. And in that side of things, I was in the investment banking side. And that investment banking is essentially an activity which investment banking and capital markets. Investment banking is essentially activities which allow companies to raise money in the capital markets. And sometimes they have activities in the corporate finance where there's mergers and acquisitions between companies. Generally, that involves capital raising as well, because if you're acquiring a company, you don't have like a huge pot of cash on your balance sheet. You have to raise that money from the markets as well. So having been on both sides of the fence, both on the sort of buy side of the investor side, which is investing in those assets, but also on the investment banking side, which is raising assets for companies. And amongst weirdly, one of the companies that did come through when I was at SBC was a coal company, and so the company that I was working for at that time did raise money for a coal company. Off the top of my head, I can't remember if we were raising money for companies that were active in animal exploitation. But certainly, had there been one of those companies that wanted to raise money, they certainly wouldn't have been refused. The bank would have definitely said, yes, we'll take on this mandate. We will raise money for you so that you can, invest in, bigger and better factory farming facilities. So yes, that level of kind of principles is mostly absent in the financial market. It's starting to come forward in the form of ESG and impact strategies, of which what we're doing is one type or a couple of types, because we're active both in the listed market, which is quoted stocks, and also in the venture capital market. But it is spreading across the financial markets to some extent, despite the best efforts of some people in the political spectrum, and also a number of the vested interests, particularly in those extractive and damaging industries that do not want to be do not want to see ESG strategies. ESG means environmental, social, and governance. So these are particular characteristics of companies that are being considered, environmental characteristics, social characteristics, and governance characteristics, which are being considered by investors when they decide if they want to invest in a company or not, or how much they want to invest in a company. And so the sort of worst end of companies clearly don't want investors to be considering those factors. Those companies are lobbying politicians to pass laws which make it difficult for investors, and particularly pension funds, to invest according to those principles. So this sort of game of money is about a lot of vested interest, and a lot of companies that are doing bad things, that want to be able to keep doing bad things because they make money out of doing bad things, spending money in order to ensure that they can keep doing those things. So this chart shows in some senses the scale of a problem. Because if I'm saying that 30,000 animals are spared by if somebody is investing in our global index in 1 year, what that means is that for every million which is invested in a standard index, 30,000 animals are being killed. And that is because of the comment that I made earlier, that the animal exploitation is endemic in our economy, and a lot of companies are making, a lot of money out of it, either quite directly, like the Tysons or the Hormels of this world, or let's say the pharmaceutical companies which are using animals for testing, or they're doing it quite more indirectly. So is a clothing company that has wool, jumpers on the shelf, they're indirectly benefiting, because obviously that wool has had to be taken from an animal at some point, even if they're not doing that specifically. And I would say that the 30,000 is actually quite it may be on the conservative side, because we are maybe a little on the low side in terms of the fish caught and farmed, and that is into the trillions. I saw the SDG 18 sort of pop up in the chat. So where this is important is not just that the SDGs are kind of, nice things to have, and they're things that people generally may be aware of, that there are such things as these SDGs, Sustainable Development Goals, which have been developed by the UN. Where it's super important is in two ways, which is that the Sustainable Development Goals which were created in 2013 with the target date of 2030 to have achieved the specific targets in those goals. It's quite likely that most will miss. Where that's important is in two ways, which is that obviously it was developed by the UN, and in concert with various groups, countries signed up to it. It means that the precepts of those goals should go into the law of those countries. But the other way that it's important is that it's the SDGs have kind of assumed a life outside of that sort of governmental action, towards also the financial markets to some degree. And that's because investors, some investors, certain groups of investors, not every investor, but an increasing number of investors over the last 10, 15 years or so have been looking to invest their money in a more impactful way, in a kind of at least do no harm way. And I would say before 2010, we had socially responsible investing, which was largely a little bit sort of values driven, somewhat religious, let's say, because it was, Catholic entities not wanting to invest in sort of pornography and whatever. Maybe Islamic entities not wanting to invest in alcohol, gambling, all of the sort of vices. So that's where it kind of started from, and then over the course of the last 10 to 15 years, it turned into this ESG, where a number of other aspects were being taken into consideration. But since the SDGs, which was 2013, so just some 11 years ago, started and got promoted, and people became more aware of them, it's actually become important for some investors to consider the SDGs either as a whole, and there are some investment programs that are trying to consider all of the SDGs, or certain ones, or to be very targeted and say, okay, I want to invest in water schemes, or I want to invest in climate specifically. And there's been an enormous amount of money raised, but probably still not enough in climate tech funds in the last few years. And that's great, because it does mean that money is being directed in this slightly more positive way. It's being invested in a kind of more proactive way in certain of these SDGs. But of course, the thing that is disappointing about the SDGs is that they do not consider exploited animals at all. They don't seek to improve the position of exploited animals at all. There is actually almost no reference to animals other than within life below water in a reference to overfishing. But obviously, as we all well know, the fact that animals are being exploited is very damaging for quite a number of these SDGs. The ones that are highlighted in colour are the ones that where it is most important, because they are the ones which are very much more around the environmental aspects, the aspects of consumption and production, the decent work one as well. I think that's very important when you consider the abuse of humans as well as animals in agriculture, farming, fishery. But the fact that there is no consideration of exploited animals led us to create our own SDG, SDG18.org. Obviously, it is not officially authorized in any way, shape, or form. It is more of a campaign at the current time. It has not been adopted by the UN, but the campaign is using the tile and the concept of an SDG in order to make people aware that A, the animals are not included within the SDGs at the current time, and B, that without the consideration of animals, it will be extraordinarily difficult to achieve most of the goals, and particularly those which are highlighted on this screen. So I've talked a little bit about financial markets. I don't have very much time left at all, but the chart is the most relevant part. On the left-hand side, I've discussed a little bit about what our approach is in terms of imposing vegan screens and proactively investing in order to achieve a vegan world. But in terms of this chart on the right-hand side, this is really how investors look at the markets and how companies also understand their interaction with the markets to the extent that they have a need for capital or funding of any other type. So you've got along the bottom axis, you've got risk, and along the y-axis, you've got return. And essentially, the higher risk you're likely to take, the higher return you will be demanding, because you're putting more of your money at risk. So you want to get more money back, not just the money you've put in, but multiples of that if possible. Just looking at that, I won't go into everything in detail, but there's a game to be played across all of the financial markets, and this game is played by hedge funds, it's played by other kinds of traders, day traders, played by the traders within the dealing rooms of banks and all types of financial institutions. In each of those dots, there will be a game that is being played. In a sense, the game. This is something that's just kind of hit me. The game becomes even more kind of Wild West the further you go up the chart there. That arrow pointing at 45 degrees or whatever it is. The more risk you're taking, the more return you want, and the worse you're likely to behave, frankly, in terms of trying to make money out of the markets. Just in the cash and cash equivalents area, there's and the short-term interbank market. There was a big scandal a few years ago in LIBOR, where there was LIBOR price fixing going on. So everybody who's at any of those points will be trying to make money. At each of those points, there are different investors and there are different counterparties on the other side, which I think is important to note. So in the cash and cash equivalents, short-term bonds, etc., you're really much more talking about government and banks and maybe municipals, so government-like entities or quasi-government type entities that are able to raise cash very short-term. And then you have obviously depositors in banks, etc. But as you go further up, where you get into corporate bonds, this is where you get involved in companies. And of course, if anybody is investing in a company, either lending to a company, so corporate bonds are basically lending money to companies. They're called a bond because they're securitized, so they're turned into a financial instrument. But essentially, you're lending money to a company, and you only lend money to a company if you think that you can, the company is going to be able to pay you interest on that, and give you your money back. And obviously, the more dodgy a company, let's say, or the lower the credit rating of the company, the more interest you'll expect to receive. So these are the kind of things that investors are thinking about. I'll jump over the gold real estate index funds and equity funds. Those are really talking about companies whose stocks are already listed on the stock market. And those are liquid, and that's a very important aspect as well. With everything below the sort of derivatives, let's say, to the left, you can instantaneously get your money back, or get all your money back necessarily, but you can instantly liquidate that asset and turn it into something else. With equity funds, index funds are really a construct, and we've constructed, obviously, index funds in order to demonstrate that it is possible to invest according to our precepts. So an index fund is basically a set of rules for investing in a stock market. And you can make those rules as easy or as complex as you like. But as they get more complex, the idea about that is to make more money, generally. Or sometimes it can be to reduce risk. So what you're trying to do is to shift your place on that curve. With the other equity funds, these are maybe the more active funds, so where you are trying to research a company, decide whether it's going to do well or do badly, and then invest based on that. What I would say about that in respect of how it's impacting animals, etc., is largely a feature of, and I'll just show you quickly another chart that's further down. Is largely a feature. Oh no, sorry, I went too far. Largely a feature of this, and you'll see that we've plotted out the SDGs in respect of our fund, and our fund is largely better than the S&P 500 on practically every single one of the SDGs. You'll see that because it's green. The green is outside the circle in the middle, which represents the S&P 500. But the thing that is important from this chart with all of the colours on is that all of these funds are supposed to be ESG funds, or they're indexes, but they're indexes which underlie funds. They're all based versus the S&P 500. So the S&P 500 is actually worse than pretty much all of these funds. To the extent that the number is below 100, the fund is better, other than in this one, which is environmental good, and the other one's social good. You obviously want to be better than the index, so above 100 in that sense. But to the extent that you're lower, you're better than the index. What that means is that the index, I mean, for example, our fund has 20% of the carbon versus the index. I've already said that we're removing 50% of the S&P 500 index. What that means is that 50% that we're removing is creating 80% of the carbon in the index. So there's a certain group of companies which are doing very bad things, let's say. They're releasing a lot of scope 1 and 2 carbon. They're releasing scope 3 carbon emissions through their supply chain. They're creating an enormous amount of waste. You'll see that our index has about 5% of the waste of the S&P 500. So the stocks that we exclude are creating 95% of pollution in the world. Again, about 5% for water consumption. So the stocks that we exclude are using 95% of the water that's being used in the world. But the problem is that those companies are not paying for it. I'll just go back up to the other one because I just want to touch on venture capital, and I see we're running out of time. So just going up that scale, as you get further and further into the risk perspective, you go towards alternative investments, which is hedge funds that I mentioned before, and then private equity, venture capital. Private equity really shouldn't be quite as far up the risk as that, because generally private equity is much larger companies that could potentially, a lot of them could potentially list on the exchange. Some of them are as large as companies which are listed on the exchange, but they've chosen not to, or they're held by private equity funds who own their capital, as opposed to investors that are stock investors on the exchange. Venture capital is a much more interesting thing, because the private equity, as I mentioned, is probably companies that are profitable. So they have a sort of sustainable, that they're sustainable in the sense that they can keep themselves going through the money that they're generating out of their operations. Venture capital is quite a different thing. Venture capital is when you're putting money into startups that have no operations to date, or may have very, very small operations, in the belief that you think those operations will increase, that you think that they will be able to grow in revenue, that growth in revenue will lead them to have profit further down the line, and that the company will ultimately be self-sustaining. And then it may be able to get growth capital, which is a sort of less risky form of venture capital, because you're putting money into a company that is already profitable, as opposed to one which hasn't got any profits, is loss-making, and maybe doesn't even have revenues. And in respect of the vegan market, let's say, or the vegan economy, these are the kind of companies that you would be speaking about in this area. So companies that are replacing proteins that formerly derived from animals, ingredients in order to create better vegan products, cruelty-free products, animal testing alternatives, alternative materials, plant-based apparel. So everything in respect of the animal exploiting companies that we're removing in our index, those products need to be created in a different format from other than from animals. But this, at this point, is a tiny, tiny amount of the market as compared to the market shares, the markets that you see there, the 1.5 trillion in animal products, the 200 billion in ingredients, the 500 billion in personal care products, the 100 billion of animal-derived materials, just reeling those numbers off. The actual market in non-animal products is tiny. We're talking in the sort of single digits to maybe double digits of billions total across all of those. And that is the problem. Because what these companies need is they need more capital. What have we seen in the last 2 years? We have seen interest rates, we've seen oil price go up, we've seen the interest rates go up. We've seen investors who now, if you go back to that chart, if you can remember that chart so that I don't have to keep flicking back to it, if you can remember that chart, venture capital was right at the very highest end of the risk chart and demanded a high return. What has changed with interest rates going up? You may get more money on cash. So the problem that we see is with cash and bonds, investors getting a lot more money back for investing in that with practically no risk. Tell me why they would invest in venture capital in that case. Out of the goodness of their heart, because they believe in these companies, because they care about the environment. No, I'm sorry. Very, very little money has gone into venture capital in the last year. Into venture capital funds, and companies have been really struggling to raise money directly because venture capital funds have been unable to raise money from the end investors, the pension funds, the very rich people, family offices, etc., insurance companies, endowments, foundations. And in addition to that, as well as those venture capital funds not being able to raise money, because of that, those venture capital funds haven't been able to put money into these companies. So we are seeing companies failing. Right now, none of the companies on screen have failed, but I could reel off names and names and names, particularly companies in the plant-based arena that have failed in the last year and a half because of lack of access to capital, because they have not reached the stage where their revenues are high enough that they have and that they have high enough gross margins. So what they are paying in order to make their products versus what they're able to sell those products for. And this particularly gets even more difficult with the cost of living crisis, where people are not prepared to pay high prices for premium products and want everything to be cheap as chips. That means that those companies basically are not profitable. And if you're not profitable, then you need to be getting more capital in, because otherwise, how do you continue in operations? They have not reached the level of revenues that allows them to become profitable. They're still on that journey to get to that place in terms of revenues where they can become profitable. and investors at this have been unwilling to put more money into those companies because the point at which they become profitable has just become too far in the future. And there are lots of other things that they can put money into. As I said, they can put money into cash and bonds and they get an immediate yield, which is, I don't know, 5% for no risk at all, or put money into something like real estate. So this is where the companies in this space are having to compete. They're having to compete for capital. And without capital, they will go out of business. And I'm sorry, but that is the game.
Hello, Claire.
Investors will not invest unless they feel that they can get more money back than they put in. And especially with venture capital, they're not just wanting large multiples of the money that they put in, but they're wanting to know that that money they're going to be able to get out at some point, i.e. those companies are going to be bought out or they're going to be able to list on the stock market within a certain period of time. And that seems all very far away now. Finished. Thank you.
Our next speaker is here, and so I think we'll have questions put in the chat. But that is fascinating, and you have excellent slides. I'm glad this is being recorded. So thank you so much.
My pleasure.